everyone, Carice Busby here. I'm a mortgage banker and help people buy and finance their homes. I also have an extensive background in investments and money, and that's what I'm super passionate about. I love educating people, helping them understand money, how it works, how it fits into their life, along with their mortgages and real estate. If you like this video, please drop me a comment and please follow my channel so that you get all my new content and follow me on social media. Today, we're talking about a really important topic. Some of the biggest financial mistakes I see as a loan officer. Over the many years that I've been in the mortgage industry, I've seen a lot of financial mistakes. Most of them don't have anything to do about intelligence or anything like that. It's really about how people think about money and their relationships with money. And while some mistakes are not a big deal, some mistakes can really cost people thousands and thousands over time if they don't get them corrected. So we're going to get into that today, and I'm going to go through and explain what some of these big mistakes are and what you should do instead. The goal is always keep your money working harder for you than you did for it, keeping your money moving. The biggest mistake I see is waiting for the perfect market, waiting for the perfect timing. You are never going to time the market. Some of the smartest people in the world, including Warren Buffett, can't even time the market. It's time in the market, not timing the market. So, waiting for lower interest rates, waiting for house prices to come down, waiting for more inventory. Here's the thing, all the time that feels safe, what you're really doing is you're trading security for higher prices. Over time, things just cost more. That's called inflation. And that's just a foregone conclusion in our world that we live in. So there's trade-offs to everything. If you are sitting out of the market waiting for house prices to come down, depending on the market you're in, you're going to be waiting for a while. But what that also means is that you're probably renting somewhere, meaning you're paying rent and you're giving your money to a landlord that owns a property. So you're just essentially taking your money and paying for your landlord's mortgage versus your own mortgage. So that's time that now you can't get back, where you could have owned something and get the equity off of the ownership of that property. Equity is the growth in that asset. So the less time you own an asset, the less growth that you have in it. So there's always trade-offs. When rates are lower, there's typically more people that are in the market. So theoretically, the house price you're going to pay is going to be higher. When rates rise a little bit, it drops some people out of the market. There's fewer people, which means less competition, which theoretically means you pay a lower price on a house. What would you rather do as a buyer? Would you rather get a lower rate and pay a higher price for a house, or have a slightly higher rate and pay a lower price for a house? Well, that's a no-brainer. You're better off to buy the house at a lower price and take initially a higher interest rate. Because you know what? You can always refinance that loan. It's not a permanent fixture. You don't have to keep that loan a long time. But you know what? You can't renegotiate the price of a house. Once you paid the price of the house, that's the price of the house. So there's always trade-offs. While sitting out the market can seem safe, it really is costing you thousands and thousands of dollars. Wealth is built on time in the market, and movement always beats perfect timing. Another mistake I see people make is focusing only on the payment. They will look at what they're paying in rent, and then they'll say, oh, but my mortgage is going to be higher than my rent. Depending on the market you're in, that is likely always going to be the case, that your mortgage is going to outweigh what your rent is going to be. But here's the thing. If you're only focusing on the payment, you're losing a lot of other stuff. You're not factoring in the investment that you're making in your own home. You now own it. So even if your payment is higher, you now, every time you make that payment, own more of that asset because you're paying more of the loan off. But the difference is you're paying your own loan off, not your landlord's loan. Plus, you get the benefit of the equity in that house. So when that house appreciates at 2 or 3 or 4 or 5% per year, you get that equity over time. It's like another savings account for you on top of your savings, your retirement, your investment. And a lot of people are really happy they have that equity in their house when they're getting near retirement because they're counting on that as a big piece of the lifestyle that they want to have in their retirement. The other piece of owning a home is the leverage and the tax benefits. As a renter, you don't get that. You only get that when you're a homeowner. Real estate is always a long-term strategy. Another mistake, using every dollar for down payment. I have people come to me and say, I'm going to put 50% down. And I say, why? Why would you want to do that? Why would you want to clean out your account and put all your money into that house? Once you put the money into that down payment, it's gone. Yes, you have more equity in the house. You have bragging rights because you have more equity. But guess what? You can't touch that equity until you sell the house or you finance it through doing a cash out refinance or doing a HELOC to get the money out of it. If you need access to that equity, you're going to have to pay transaction fees to be able to access it. So here's another approach that I suggest for clients. Go ahead, let's find the right amount of down payment that's going to work for your financial strategy and your payment comfort level. Put that amount of money down. Then take the rest of it and let's put that into a smart investment vehicle that is going to allow your money to keep moving so that it keeps earning off of itself. So if you can put it into a high yield savings account, you can put it into the market. Maybe you put it into an S&P ETF fund that is making on average 10% of return a year. That means your money is making money off itself. When you put it towards your down payment and it's sitting in equity, guess what? It's dead equity. It's no longer moving. It's doing literally nothing for you. So, smart strategy, figure out what the smart down payment option is going to be. Then take the rest of your money and put it into an appropriate investment vehicle that is going to allow you to keep earning off of the principal of that investment. So your money is always working for you. Big mistake that I see people make, carrying high interest rate credit card debt. Credit card debt is not good debt. There's good debt and there's bad debt. Mortgages are good debt. Credit cards are bad debt. Every month, if you have a credit card, you should pay off that credit card balance every single month. If you can't pay that credit card balance off every month, you should not spend what you're spending on that credit card for that month. That's how credit cards were designed to be used. The average interest rate on a credit card is 24 to 25%. You will never get ahead of the game and get out of debt if you're only paying the monthly minimum payment. The only way to get ahead of that is to be able to make a large payment against the principal, to be able to get ahead of it so that the interest doesn't keep compounding on itself. Compound interest works both ways. It is phenomenal when it's on your investments and it's compounding on itself. It also works with credit cards, and that's not a good thing because as the balance keeps getting bigger, it keeps compounding on itself. So that's going to be your number one strategy. If you have high interest rate credit card debt, that's your number one thing you want to work at paying off. Start with the highest interest rate first and then work your way down in the snowball method. But that is going to be the number one thing. Get that credit card debt paid off. It's not good debt. Treating real estate as a short-term decision is a bad strategy. Real estate is a wonderful investment as long as you're looking at it long-term. Be prepared to own that home at least 5 to 10 years. And if you're not prepared to own it 5 to 10 years, then don't buy it. Here's the reason why. Markets cycle and markets fluctuate. There's market volatility. If you look at past cycles in the United States, we have financial cycles every 5, 7, 10 years. Typically speaking, if you own real estate 5 to 10 years, you're going to be able to have an opportunity to be able to resell that asset and recoup some of your losses. If the property happened to go down in value after you bought it, I'll give you a great example. I bought a condo in 2007. It was going to be my primary investment or my primary residence. So I was living in it. I was planning on living in it long term. So I really did not care in the interim what would happen. I bought it at the top of the market before the financial crash. So in owning that condominium, it went down in value for 5-6 years or so while we got through that financial crash. I really didn't care. It was my primary residence and I wasn't going to sell it, and I was planning on owning it at least 5 to 10 years. I knew that likely by the time I hit 10 years, whatever was happening in the market, I'd be in a position where the value of it had likely rebounded to at least what I paid for it, if not a profit. The moral of the story is, by holding that condo for 10 years, I sold it at a 10% profit. Had I needed to get out of it 5 years earlier, I would have sold it at a 20% loss. So that's the moral of the story. When you're buying real estate, make sure you're prepared to own it at least 5 to 10 years. Another mistake, sitting on too much cash. I can't tell you how many bank statements I look at for people where they've got $100,000 sitting in an institutional, like a Wells Fargo, Chase, Bank of America, checking account, savings account that's paying them 0.25%. They're literally losing money every single month because inflation at 2 to 3% is eating up that money. So that money's just sitting idly, losing value every single month, and it's just sitting there. My recommendation always is you want to keep 3 to 6 months of an emergency savings in a high yield savings account. High yield savings accounts pay higher than a regular institutional bank because they don't have the brick and mortar overhead. You can typically right now get around 3.5% to 4% on a high yield savings account if you want it in liquid form. That at least outpaces inflation, and that money is there. You can easily transfer it into your checking and savings account anytime you need to pay your bills. You should use your checking and savings account at the institutional bank that has a branch that you use to pay your bills simply as a pass-through account. You should only keep enough in there to pay your bills every single month. You should try to keep as zero of a balance as you possibly can. Keep your cash in a high-yield savings account, and the rest of it should go into the market, into a suitable investment that makes sense, that's going to give you a return on your investment so your money is working for you long term. Sitting on money loses power. And likely the most important mistake is fear. Using fear when making decisions. Fear of buying at the wrong time. Fear of a volatile market. Fear of risk. All three of those things are always going to be present at all times. The markets are never going to be calm. It's never going to be the perfect housing market. There's never going to be no risk. You've got to look through and balance out and realize there's always a risk reward and move forward with a strategy that makes sense. That's why it's important you have your trusted advisors, a trusted mortgage advisor, a trusted real estate agent, financial advisor, where you can huddle and look at what your lifestyle is. What are your long-term financial goals? What is your lifestyle needs? And that's going to be the driver of your decisions. Make your decisions from a standpoint of empowerment versus a standpoint of fear, and you will come out ahead every time. As always, your money should be working harder for you than you did for it. Keep your money moving. If you enjoyed this video, please comment below. And if you have any questions for me about mortgages or money, I am always happy to help. Please drop me a message and I'd be happy to talk with you further about it. Please subscribe to my channel so you get all of my new content and follow me on social media. And until next time, see you soon.